Hello, everyone, and welcome on my new channel, Macronomics. My name is Martin. I'm a global macro strategist. I write a Substack page, which is called Macronomics, and this presentation, which will be available as well on Substack, I will put the link in the description of the video, is relating to the money illusion. We're going to be discussing this environment, which is akin to money illusion. What is happening right now, what are the prospects, what are some illustrations, what are some recommendations. So please bear with me. Let's go through. We will go through this presentation. Any questions, don't hesitate to put it in the commentary, and let's go. So there we go. The presentation is entitled The Money Illusion. So why the money illusion? Why the title of this presentation? Well, the term money illusion was coined by a great American economist called Irving Fisher, which you might have heard about. He wrote it first in a book called Stabilizing the Dollar. And it was as well popularized by John Maynard Keynes, another brilliant economist, in the early 20th century. Irving Fisher, as well, as a reminder, was the one who produced the equation, which is called the Fisher equation, in the financial mathematics and economics, which estimates the relationship between nominal and real interest rates under inflation. So that's very, very interesting. The money illusion is indeed a cognitive bias, which can vary depending on the inflationary-deflationary context. As well, the money illusion, which was dear to Irving Fisher, it is when people have a tendency to view their wealth and income in nominal dollar terms rather than recognize the real value adjusted for inflation. So that is what is called the money illusion. Some other macro thoughts relating to money illusion. Most progressive tax systems in the world are not adjusted for inflation. When wages and salaries are rising in nominal terms under the the influence of inflation, then obviously they are becoming more highly taxed, even though in real terms, the value of the wages and the salaries has not increased at all. This phenomenon, if you want to look it up, it's called bracket creep. So overall, the net effect overall is that in real terms, taxes are rising, unless, of course, the tax rates or brackets are adjusted to compensate for the inflation effect on the rise. That's simple. What we've seen so far this year, we've seen a big rally in metals such as copper, obviously gold and silver, which suggests to us a flight from money, which is a situation where everyone is concerned about the value of the money you have in your pocket falling apart. You can see this phenomenon happening when you have episodes of hyperinflation, like you had in Zimbabwe, or episodes of high inflation, which was the case during the 1970s, where you had like stagflation, in the sense that you had low economic growth as well as high inflation. What we're seeing is silver prices, copper prices, and uranium, which have had significant rallies during the whole year, which indicates a shift towards precious metals as well as industrial commodities. Obviously, the big concern, regardless of the result of the elections with the election of President Donald Trump, is the current US budget trajectory and the concept of fiscal dominance, which are influencing the behavior of the commodities and the US dollar. So let's look up a few charts to go through the money illusion effect. So despite all the hype about US stocks, they are not the best performer year to date. If we look at Bitcoin, for example, it's up by around 90%. Silver is second place with 31% around, and gold is up by 30%. If we move to the next slide, if we look at the chart for the last 3 years, gold was up by 48%, silver prices by 30%, utility sector by 29%. If we look at this chart, which is obviously not a performance chart, but it shows you that something happened in 2002 where there was a breakdown in a lot of the relationship. But the trend in terms of money illusion is the same. You have the rise of gold prices, the rise of the S&P, the rise of the Nasdaq 100, and the rise of Bitcoin. Everything is rising because we are in an inflationary boom. We are in an inflationary environment. As such, as I mentioned before, and this is a great chart produced by our friends at Gavekal Research, and it was published on their LinkedIn profile. It shows you the relationship between gold prices and real yields. And you have something that broke after the freezing of the Russian central bank assets in 2022. So maybe it's a coincidence, but maybe it's not. So in the below chart, you can see that there's a lot of things happening on this chart. First of all, you have in the red curve, which is here, you can see that the U.S. central bank balance sheet is in red. As well, we've added gold, Walmart stock price, coffee, orange juice, and cocoa, which are soft commodities. Walmart, we're going to explain you the next following charts why we put Walmart on the chart. Given that the United States do not produce cocoa, as the US dollar weakens, cocoa prices, orange juice, and coffee are becoming more expensive because the United States is a net importer of coffee as well as cocoa. And as the United States sell more debt and goes deeper into debt, the US dollar devalues, and you can see this in soft commodities and gold. Why? Because gold is true money. As JP Morgan used to say, gold is money, everything else is credit. So the month of October has shown some devastating results overall. Gold prices were up in euro terms by 6.8%. Global government bonds were down by a minus 1.4%. And that's a massive 8.2% gap in just 1 month. So the question is how long until clients of the much vaunted portfolio 60-40 will say enough is enough. As a reminder, a 60-40 portfolios is 60% equities, 40% fixed income, 40% being the protective nature of normally the safest government bonds of a country. Moving on to the next chart, gold has seen a record high recently. It's up 30% year to date, and it's on pace for the best annual performance this century. So gold is absolutely going ballistic. We've seen that in 2024, as well as for Bitcoin and other precious metals such as silver. What's going on? Well, central banks are now holding around 12.1% of global gold reserves, which is the highest level since the 1990s. And this percentage has skyrocketed this year, and it has more than doubled over the last decade. Who are the buyers? Well, you've got China, you've got India, you've got Turkey, and you even have Poland, which have been the largest contributors to global central bank reserves when it comes to adding gold to their reserves. What's going on in the United States is concerning because right now the US is spending around 17.9% of its revenues on interest payments only, which is the largest share in more than 30 years. That's why we're talking about fiscal dominance, because the US budget trajectory is currently out of control. The next chart is showing you the relationship which has been established in 2022, which is the Japanese yen weakening when the US 10-year US Treasury yield is going up. The US 10-year yield is in the driving seats. So what we mentioned about a couple of weeks ago to our readers of our Substack page is that the US yield should go up more in the near term given the US budget trajectory. And it's quite interesting to see that when the Fed started cutting rates by 50 basis points in September, since the first rate cut, The US 10-year yield has gone up by around 70 basis points, which is a massive, massive move. So as you can see in this chart where the US 10-year yield is going, the Japanese yen is following. So as we mentioned, gold is now up 30% year to date. It will continue to go up on strong Asian demands as well as central bank demands and as well as rising geopolitical risk. Silver is the winner so far, up by around 31.6%. So we are currently in an inflationary boom. Just for fun, up to the races, what's your year-to-date winner? Is it NVIDIA, the tech shares? Is it Bitcoin? Is it cocoa? Right now, NVIDIA is winning. The scarcity principle applies to cocoa based on stronger demand from Asia, as well as poor harvest and not enough supply. So cocoa might be the next chocolate gold. How to play in an inflationary boom? Well, we have a few things that we want to look at, a few indication about what's going on. On this chart, we've put some gold. We've put Philip Morris and Walmart versus the ETF of US Treasuries, which is called TLT, as well as the ETF for US Treasuries, but the zero coupon, which is called ZROZ. And we recommend looking at Philip Morris, which we call the Stanley Druckenmiller trade. Stanley Druckenmiller being a very big global macro maverick. He has a huge performance, and he's been buying some Philip Morris shares, and we will explain you why, and as well why we think Walmart is a good way of protecting yourself against inflation in an inflationary environment. The chart below displays Philip Morris behavior and its performance in the 1970s until 1983, which was a period of high inflation. As you can see, the stock went up by around 800%, which is not bad. So why did we put Walmart and Philip Morris on our previous chart? Well, if I take the chart, it displays, the chart below displays the performance of Walmart from 1970 to 1982, which is roughly during a period of high inflation in the United States. And apart from the outliers, which was McDonald's, Walmart outperformed. It went up by 1,232%. And as we shown before, Philip Morris was up by around 800%. So as our good friend Geoffrey Fruwe, who used to be head of research of a large hedge fund in New York, tobacco does not really perform. In fact, its ratio to gold is the same as in 1904, which was the gold standard era. So what's going on is that you see a large wealth transfer from Philip Morris to equity holders. And as a result, Philip Morris' best growth was during the 1970s. You can short as well the US dollar against gold, but against cigarettes, yeah, it does work actually, and it will continue to work. Why so? Because tobacco has the highest inelasticity of demand to price of any commodities. Tobacco used to be money in Virginia for more than a century. As well, it was money in Berlin following the Second World War, and it's still being used as some kind of currency in prisons, in jails. It is also a bet against the currency and also on inflation in 1971 fashion. So tobacco shares are indeed kryptonite when you have a fiscal dominant situation, like you have seen in many instances in Latin America and what you're starting to see with the United States until they put their fiscal house, I would say, in order. So as our presentation goes, we've entered an era of money illusion. And in this kind of environment, you want to own assets which are performing better relative to Veblen effect. You can check online what Veblen effects are. You want to own assets such as which are exposed to Veblen effect like MicroStrategy or Alliance Resource Partners, which is a coal producer. Or you want to own scarcity assets which are exposed to gold and silver, such as gold and silver miners. So many financial pundits on X and Twitter thinks that MicroStrategy is the best beta asset relative to Bitcoin. But you can look at as well Alliance Resource Limited Partners, given that we think it can be a little bit a safer play than MicroStrategy, less volatile, because rather than issuing debt to buy Bitcoin, Alliance Resource Limited Partners, we're going to see it in the next slides, they are mining Bitcoin rather than issuing debt to buy Bitcoin like MicroStrategy is doing. So yes, MicroStrategy has returned around 136% in terms of Bitcoin since around for the last few years, since September 30, 2021, whereas ARLP, Alliance Resource Partners, has only returned 108% in terms of Bitcoins for the last 3 years. So both, it appears to us that Alliance Resource Limiters is both a Veblen effect and a scarcity play because you play Bitcoin and you play the rise in coal prices. So what should be a new benchmark to measure the performance of a stock relative to Bitcoin or gold? Well, if we look at Walmart and we mention what Walmart has been doing, it has returned around 2.7% in terms of Bitcoin for the last 3 years. But if we take Walmart relative to gold, it has returned 18% since September 30, 2021, so roughly around 3 years. So in effect, Walmart is protecting your purchasing power relative to inflation if you consider gold to be a good measure about the depreciation of the value of the currency. So if we take MicroStrategy and Bitcoin, they've been moving in sync. But given that MicroStrategy is a leverage play on Bitcoin, we consider it as its second derivative. So year to date, you've seen a very significant rally on both Bitcoin and MicroStrategy. And this is telling you that liquidity has been rising in this inflationary environment. So you need to watch both names for liquidity cues and fragility of the market. Right now, so far, so good. This below chart shows you the performance of MicroStrategy relative to Bitcoin for the last 3 years. And as you can see, this year, the MicroStrategy has exploded higher relative to Bitcoin. Back in December 2020, we recommended some of our clients on Home Research, which is a platform we have contributed to. We recommended some two coal players such as ARLP as well as BTU, which is Peabody Energy at the time. Both were trading at $5. Now they're both trading around 26 for BTU and around 25 as well for Alliance Resource Limited Partners, ARLP. What is funny about ARLP is that they produce mine, but they're also mining Bitcoin. And they're currently holding around 425 Bitcoin on their balance sheets. And for them, the operational cost of mining Bitcoin is around $24,000 when Bitcoin is now trading around $81,000. So you do the math. They also have a 12.5 dividend yield. So they are mining Bitcoin with excess electricity in their mines. So they are cleverly buying Bitcoin for reduced cost. So that's why ARLP is a funny play. Next chart show you the performance of Alliance Resource Limited Partners. And obviously, it's been outperforming BTU, being less volatile with their mining strategy of Bitcoin. Next chart, if you want to measure the performance of ARLP relative to Bitcoin, the last 3 years, Alliance Resource Partners has returned 89.3% in terms of Bitcoin. If we take the luxury sector, the best luxury stock out there is clearly Hermes relative to LVMH. It's really depending on Asian demands. But if you look at the secondary market and what the Veblen good is effectively, It's a good which is on high demand because of its attractiveness. And as such, Hermes bag continues to grow in value, but on the secondary market, by an average of around 14%. So don't tell that to your wife or your girlfriend. But Birkin or Kelly bag is a very good investment because it's on the secondary market, it keeps going up and up and up. And the share prices as well of Hermes is going up and up and up. It's much more a defensive play if we look at these charts. Uh, Hermes has been year to date holding its ground much better than LVMH. It is much more resilient to that effect. So this is a reminder from a note I've published on my Substack on 13th of July. As a reminder, again, I will put the link to my Substack page if you want to look at the notes on the Substack, which is Macronomics Substack. This what was David Goldman, which is a strategist, macro strategist, was saying. It used to be that when the policy compass was spinning and you didn't know how to predict how governments would react, and you didn't know if you needed to hedge for inflation or deflation, so you were obviously hedging for both and buying a put call parity, which is buying gold as well as US treasury bonds. It used to work very nicely until it's not working anymore, which is the case right now. As you can see the below chart, we've put GDX, which is the index for gold miners, versus ETF TLT, which is a proxy for US treasuries, as well as ETF ZRZ, which is much more sensitive because it's a proxy for zero coupon and long dated US zero coupons, which is 25 years plus, which is a PIMCO ETF. And below you have the 3-month chart. And as you can see, US treasuries are not really safe anymore because the US needs to put its fiscal house in order. We'll go on for a few charts, food for thoughts. First one is showing you that US manufacturing has been slowing down in October, printing at 46.5 with a forecast at 47.6. As a reminder, anything above 50 is equal to economic expansion, and everything below 50 is contraction. So what we're seeing is a strong divergence with China. China is still printing a positive figure at around 50.3, which is slightly above economic expansion. And if we look at this great chart produced by top-down charts, which we saw on our X feed, you can see there's a big discrepancy between the ISM manufacturing PMI and the S&P 500 year-on-year performance. So there's something going on. It's clearly a sign of an inflationary boom going on in the US. Next chart shows you the performance of government bond yields on the 10-year brackets during the course of 1 month. And as you can see, global yields are rising, not only in the United States, it's the case in the United Kingdom, in Germany, in France, Australia, and New Zealand. Why that? Because a lot of Western countries are facing budgetary issues like the United Kingdom. So they've seen a lot of pressure coming on United Kingdom bonds. And as well, you've seen a huge drop in French manufacturing business climate, which is indicative of very big issues in the French economy. And we've seen the broadest decline in sentiment outside COVID and since the great financial crisis. So all eyes are on the PMIs, but the economy of Germany and France are facing significant issues right now. Finally, this chart is showing you that China continues to stockpile silver. The Shanghai silver vaults has hit the highest level since September 2023. They've added around 90 tons to around 1,328 tons or 42.7 million ounces. So Chinese are still buying with their both hands, both silver and gold. And finally, what's quite interesting is we've seen a little bounce in China home sales, which has been rising the first time this year in the month of October, following Chinese government stimulus measures. So the conclusion, what is on our radar during a money illusion? Well, we want to highlight a few things. Year to date, uh, we and we've been liking the theme of nuclear energy and their returns. And the below chart, we've put URNM, which is one of the largest ETF to play the thematic nuclear theme. But NUKZ, sorry, is the ETF which is outperforming in the sector. It's a new ETF which was launched on the 24th of January, and it's significantly performing much better than ETF URNM or ETF URA. So if you want to play the nuclear theme, that's one ETF you can look at. We've as well displayed Haya, which is a gold and silver miner, which is performing very well, and it's been performing very well for the last 5, even 10 years. We've put Walmart. We've explained you why we've put Walmart, because Walmart doing great during high inflation area. We've put Zijin, which is a Chinese gold miner, which as well is performing much better than gold. Philip Morris, the tobacco play, we've explained why. We'll also put Alibaba and PayPal, which is as well some names you want to look at. Finally, our last chart, it tells you that sanctions and wars are inflationary in nature. We are in an inflationary environment because of wars and sanctions. And the below chart, you see there's a huge gap between the 10-year versus oil prices. So we don't think inflation is really over yet. We've seen a huge move in 10-year bonds relative to oil prices. So let's see what goes on in oil prices in the coming month. So overall, and finally, our conclusion that we prefer having stocks over bonds because it's fiscal dominance. And until the United States put its fiscal house in order, well, you're much better owning stocks over bonds. And if you want to reach out, don't hesitate to look at our Substack page or in the comments. We'll be happy to reply to anything you want to ask on that. And that's the end of our presentation.